November 10, 2021. El Salvador and Nayib Bukele, the 40-year-old president of a country with a GDP smaller than the city of Baltimore, stands in front of cameras and announces that Bitcoin is now legal tender. Every Salvadoran must accept it as payment. The government has loaded $30 worth of Bitcoin onto a digital wallet for every citizen in the country. Bukele calls it a revolution. He calls Bitcoin the future of money. He puts the entire national treasury into it. And then Bitcoin drops 65%. El Salvador's pension funds, which the government had used to buy Bitcoin at the peak, lose hundreds of millions of dollars. The country comes within weeks of defaulting on its sovereign debt. The International Monetary Fund, which had warned against the plan 9 times in writing, watches from the sidelines. On the same day Bukele made his announcement, a 22-year-old in New Jersey named Tyler was borrowing against his student loan refund to buy Shiba Inu, a cryptocurrency created as a joke, named after a dog, with no function, no team, and no white paper, that had just risen 800% in 2 weeks because Elon Musk tweeted a picture of his puppy, and a 67-year-old retired teacher in Phoenix was withdrawing her IRA to buy Bitcoin because her grandson told her she would be left behind if she did not. How does a joke coin, named after a dog, move 800% in 2 weeks? And why does every generation produce a version of this, a new asset class that promises to make money obsolete and ends up making people broke? This is the story of the cryptocurrency speculation cycle. By the end, you will understand the specific financial architecture that turns a genuine technological idea into a speculative engine. See exactly how this pattern has run and reset and run again since 2011, and recognize the markers that appear every time the next wave is forming. This is not a verdict on blockchain technology. It is a record of what human beings do when a new kind of money appears and nobody knows yet what it is worth. It is the fall of 2008. The global financial system is collapsing. Lehman Brothers is gone. Washington Mutual is gone. The United States government has just committed $700 billion to buying the toxic assets that the banks created, and the regulators did not stop. Millions of Americans are watching their retirement savings evaporate inside a system they did not design and could not control. And somewhere in this environment, a person or group of people using the name Satoshi Nakamoto publishes a 9-page paper describing a peer-to-peer electronic cash system that does not require banks, does not require governments, and cannot be inflated by any central authority printing more of it. The paper is circulated on a cryptography mailing list. It gets about a dozen serious responses. The people who read it understand immediately that the technical solution Nakamoto has described, using a distributed ledger secured by cryptographic proof of work to solve the double spending problem without a trusted intermediary, is genuinely novel. Nobody has solved that problem cleanly before. The paper is real computer science, not a white paper for a product that does not exist yet. Nakamoto mines the first Bitcoin block on January 3, 2009, embedding in it a headline from that day's Times of London: Chancellor on brink of second bailout for banks. The timing is not accidental. The political statement is built into the foundation. The economy that Bitcoin enters in 2009 carries the wreckage of what just happened. Trust in financial institutions is at a generational low. The Federal Reserve has cut rates to near zero and is expanding its balance sheet at a pace that genuinely concerns economists who have no ideological objection to central banking. The argument that fiat currency is structurally vulnerable to debasement by governments with short-term political incentives is not a fringe argument. It is a mainstream concern being published in the Wall Street Journal and discussed in congressional testimony. Into this specific cultural moment, Bitcoin arrives as something that a certain kind of technically sophisticated person finds deeply compelling. A monetary system governed by mathematics rather than institutions, with a fixed supply cap of 21 million coins written into its protocol, transparent and auditable by anyone. Meet Hal Finney. He is a cryptographer, one of the early contributors to the Pretty Good Privacy encryption software and one of the first people to correspond with Nakamoto publicly. He receives the first Bitcoin transaction in history, 10 coins from Nakamoto on January 12, 2009. He runs the Bitcoin software on his computer and mines early coins at a time when no one knows whether the whole thing will survive another week. He is not speculating. He is experimenting. He posts on the Bitcoin forum in 2009 that he imagines a future where Bitcoin is the reserve currency of the world and a single coin would need to be worth around $10 million for that to be true. He is diagnosed with ALS shortly after and dies in 2014, having never sold most of his coins. Having watched the price go from $0 to over $600 during his lifetime without treating it as a windfall, he treated it as a proof of concept. But Ross Ulbricht sees something different in Bitcoin. He is 27 years old, a physics graduate from the University of Texas, with libertarian political convictions and an entrepreneurial instinct for arbitrage. He builds a website called Silk Road in 2011 that uses Bitcoin as its payment layer precisely because it is hard to trace. Silk Road becomes the first functioning marketplace for illegal drugs on the internet, and between 2011 and 2013 it processes roughly 9.5 million Bitcoin in transactions, a number that in 2011 dollars represents about $1.2 billion in business. Ulbricht is eventually arrested and sentenced to life in prison, but the specific use case he demonstrated, that Bitcoin could facilitate transactions that the banking system could not or would not process, changes how a certain kind of investor thinks about the asset, if it is useful enough for people to take legal risks to use it. The demand floor is not zero. And then there is Roger Ver. He is a Bitcoin entrepreneur and investor in the early years, who earns the nickname Bitcoin Jesus for his early and aggressive promotion of the asset. He puts money into Bitcoin startups, publishes articles, gives interviews, appears at conferences. He genuinely believes, in the way that true believers believe things, that Bitcoin will replace the dollar. He is also, and this is the part that does not appear in the conference presentations, a major early holder of Bitcoin at a cost basis near zero. When Ver promotes Bitcoin, he is promoting something he holds. His enthusiasm and his financial interest are identical. This is not unique to Bitcoin. It is the structure of every early asset class where the promoters are also the largest holders. What none of them know yet is that the pattern they are setting in motion will run through 3 full cycles of mania and collapse before most people who buy Bitcoin have ever heard of Satoshi Nakamoto, the innovation that lights the first fuse is the Silk Road discovery period, roughly 2011 to 2013, when a niche asset held by cryptographers and libertarian idealists starts getting attention from people with different interests. Bitcoin hits $1 in February 2011. By June 2011 it is at $32. Then it crashes back to $2. Then it recovers. The pattern of vertical rise and vertical collapse repeats twice more in 2012. Each cycle attracts a slightly larger group of buyers, and each recovery after a crash brings the price to a higher floor than the previous floor. The floor pattern matters because it tells experienced traders something. There is a base of buyers who will not sell below a certain price because they believe in the long-term case. That base grows with each cycle. The first real mania arrives in the spring of 2013. Cyprus is in a banking crisis. The Cypriot government, to meet the terms of an EU bailout, imposes a levy on bank deposits above €100,000, meaning the government takes a percentage of what people have in the bank. It is called a bail-in. It is the first time in modern European history that a government has directly seized private bank deposits, and on March 18, 2013, the day the Cypriot bail-in is announced, Bitcoin trades at $47. By April 9th, it is at $266. That is a 465% move in 22 days. A Cypriot accountant named Mikhail moves €50,000 into Bitcoin the week of the announcement. He tells his wife it is an emergency hedge. By April he has tripled his money. By December 2013, when Bitcoin hits $1,242, he is a millionaire on paper. He does not sell. The price drops back to $200 over the next 2 years. He holds through that too. The word gets out differently this time. The Cyprus crisis is covered by mainstream financial media, and the coverage frames Bitcoin as a potential hedge against government seizure of bank deposits, which is exactly what happened in Cyprus and which is also, depending on your reading of monetary history, either a once-in-a-generation event or a template that other governments might follow. Bitcoin's price chart from early 2013 appears in Bloomberg terminals. Portfolio managers who have never heard of Satoshi Nakamoto start asking questions. Then in 2017 the machine shifts into a gear that no previous cycle had reached. The innovation driving it is not a new use case for Bitcoin. It is a new financial instrument built on top of a different blockchain. Ethereum, launched in 2015 by a 19-year-old Russian-Canadian named Vitalik Buterin, introduces the concept of smart contracts, self-executing code that lives on a blockchain and automatically performs transactions when certain conditions are met. Smart contracts make it possible to create new tokens without building a new blockchain from scratch. Any team with a white paper and a website can issue a new cryptocurrency in days using Ethereum's infrastructure. These are called ICOs, initial coin offerings, and between January and December 2017 they raise approximately $5.6 billion from investors around the world. Most of it from people who do not read the white papers, and most of the projects without working products. A San Francisco software developer named David buys $2,000 of Ethereum in January 2017 at $11 per coin. By June, his position is worth $38,000. He tells nobody because he cannot believe it himself. In July, he puts another $10,000 in. By December, Ethereum is at $700, and his total position is worth over $400,000. He is 29 years old and has never made more than $85,000 in a year at his job. He does not sell in December. He does not sell in January 2018. He is waiting for $2,000 per coin, a price that people in the Telegram groups he follows have been citing as the baseline of a conservative projection. The Telegram groups, the Reddit forums, the Discord servers. This is the social proof mechanism of the 2017 cycle, and it operates at a speed and scale that no previous speculative mania had access to. In 1720, the South Sea Company needed coffee houses and printed pamphlets. In 1929, the stock market needed brokerage offices and newspaper tips. In 2017, a coin can go from unknown to $1 billion market cap in 72 hours. Because a coordinated group of holders spam every social platform simultaneously with the same message. This is the next Bitcoin. Strangers on the internet become financial advisors to each other. Nobody has credentials. Nobody has audited the projects. The only proof of validity anyone needs is a rising price chart. Coin launches in September 2017. It is a cryptocurrency designed for the dental industry. Its stated use case is to allow dentists to receive payment in a proprietary token and to allow patients to earn tokens by leaving reviews. By early 2018, DentaCoin's total market capitalization reaches $2 billion. $2 billion for a dental review token with no working product. This is the number that tells you where the cycle is, not the Bitcoin price, not the Ethereum price. The $2 billion dental coin, this is the top. Nobody knows it yet. Then, on January 16, 2018, something happens that almost nobody outside the regulatory community notices on that specific day. The South Korean government announces it is considering banning cryptocurrency exchanges. It does not ban them, it considers banning them. The announcement is walked back within 48 hours. But the 72-hour period in which the ban seems possible is enough to break the confidence of a market that has been running on confidence alone. Bitcoin drops 25% in 3 days. It does not recover. The mania phase is over. By February 5, 2018, Bitcoin is at $6,200, down 68% from its December peak. Ethereum falls from $1,400 to $100 by December 2018. Eco tokens that raised $5.6 billion in 2017 are, by 2019, worth a collective fraction of what investors put in. A Congressional Research Service report published in March 2019 estimates that of the 902 ICOs launched in 2017, more than half have failed or show no activity. David, the San Francisco software developer, watches his $400,000 position shrank to $28,000 and does not sell because selling would make it real. He still holds some Ethereum today. The position is worth more than he paid. He does not think about it the way he thought about it in December 2017. The teacher from Phoenix who bought Bitcoin in November 2021 sells in January 2022 at $35,000. She had bought at $62,000. She loses $29,000 from her IRA, which takes her 4 years of retirement income to rebuild. She does not tell her grandson, Tyler, who borrowed against his student loan to buy Shiba Inu, holds for 6 months while the coin drops 80%. He sells in May 2022 at a 60% loss and pays the loan back from his salary over 18 months. He still checks the Shiba Inu price occasionally. He is not sure why. And in San Salvador, the president's Bitcoin experiment produces this. By June 2022, the government's Bitcoin holdings have lost $56 million in value on a total investment of approximately $105 million. The Chivo digital wallet, which the government built to distribute Bitcoin to citizens, is used regularly by fewer than 5% of Salvador. Most of the initial $30 sign-up bonuses were withdrawn and converted to dollars immediately. Street vendors who accepted Bitcoin did so for 3 months and then stopped because the price swings made pricing impossible. El Salvador reaches a deal with the IMF in December 2024 and quietly scales back its Bitcoin legal tender policy as part of the terms. Bukele does not hold a press conference about it. And still, nobody asks the real question. So what does the conventional story say about crypto? It says Bitcoin is either the future of money or a speculative bubble. It says the debate is between the believers and the skeptics. That framing is where most people get stuck, treating it as a question of faith when what actually happened is documented in transaction records that anyone can examine. What actually happened across each of the three major cycles, 2011 to 2013, 2016 to 2018, and 2022, is that the same financial architecture built itself on top of a genuine technical innovation and then ran the bubble formula with increasing efficiency each time it reset. The technical innovation is real. Satoshi Nakamoto's 2008 white paper solved a genuine computer science problem. Vitalik Buterin's smart contract architecture enabled decentralized applications that have real use cases in finance, supply chain management, and digital ownership. These things are true. They are also almost entirely separate from the price of Bitcoin in any given week, because Bitcoin's price is not set by its utility as a payment system. A Federal Reserve working paper from 2022 found that Bitcoin processes approximately 300,000 transactions per day. Visa processes 500 million. Bitcoin's price is set by the expectation that other people will pay more for it in the future, which is the definition of a speculative asset rather than a monetary instrument. The new paradigm arrives in every cycle with different language but the same claim, that traditional financial rules do not apply to this asset, because this asset is categorically different from everything that came before it. In 2013, it was Bitcoin as a hedge against government seizure of deposits, a Cyprus hedge. In 2017, it was token economics, the idea that the scarcity mechanisms built into crypto tokens would generate price appreciation as a mathematical inevitability. In 2021, it was the institutional adoption narrative, the claim that MicroStrategy and Tesla and Square and BlackRock filing for a Bitcoin ETF meant that digital gold was entering the same asset class as physical gold and would be held by every major portfolio in the world. Each narrative is partially grounded in reality. Each narrative also breaks before the peak. Easy money drove all three cycles from underneath. The 2013 cycle runs partly on the Cyprus crisis, but also on the first wave of very low interest rates after 2008, when money market funds were paying essentially nothing and any asset with a return narrative attracted capital. The 2017 cycle runs on cheap credit flowing to retail traders through zero commission, apps and credit card cash advances. Chainalysis, a blockchain analytics firm, estimates that approximately $400 million in credit card cash advances flowed into cryptocurrency exchanges in January 2018 alone. The 2021 cycle runs on $2.8 trillion in direct government stimulus payments to American households, a portion of which flows immediately into Robinhood and Coinbase. Apps specifically designed to make trading feel like a game. Social proof in the 2021 cycle is the most concentrated and fastest moving version of it that any speculative market has ever produced. CNBC runs a Bitcoin price ticker. Matt Damon films a commercial for Crypto.com that airs during the Super Bowl. Larry David films a commercial for FTX. Tom Brady films a commercial for FTX. Spike Lee films a commercial for a digital payments company. These are not random choices. These are the social signals that reach people who have never owned a financial asset in their lives, the people who are last into any mania and who provide the exit liquidity for the people who got in early. The complexity in the 2021 cycle reaches a level of abstraction that defies parody. Non-fungible tokens (NFTs) allow people to buy cryptographic proof of ownership of a digital file, an image or a video clip or a tweet, that anyone in the world can view for free. The artist Beeple sells a JPG file for $69 million at Christie's auction house in March 2021. A video clip of LeBron James dunking, something anyone can watch free on YouTube, sells as an NFT for $387,000. Yuga Labs creates the Bored Ape Yacht Club, a collection of 10,000 cartoon ape images with slight visual variations, and sells them for an average of $200,000 each by early 2022. The total value of NFT sales in 2021 reaches $25 billion. By 2023, trading volume has fallen 97%. The Bored Apes that sold for $200,000 trade at $3,000. The LeBron dunk clip trades at $15. The warning that gets dismissed in each cycle is a variation of the same warning. In 2017, the economist Nouriel Roubini, who had predicted the 2008 housing crash accurately enough to earn the nickname Dr. Doom, testifies before a Senate committee that cryptocurrency is the mother of all bubbles and that the entire ecosystem is built on fraud, hype, and shock. The crypto community responds by creating a mock award ceremony calling him Dr. Doom and Gloom. Prices continue rising for 3 more months before collapsing. In 2021, the Federal Reserve Governor, Christopher Waller, gives a speech in November saying he sees no financial stability risk from cryptocurrency because the market is too small and too isolated from the real economy to cause systemic harm. He is right about the systemic risk. He is not right that the market is small. 1 month later, FTX, the third largest cryptocurrency exchange in the world by volume, is valued at $32 billion by venture capital investors, including Sequoia Capital and Soft. 11 months after Waller's speech, FTX collapses in a week, taking $8 billion in customer funds with it. Once you see this pattern, you cannot unsee it. Now look at 2025. Bitcoin is trading at approximately $85,000 as of early 2025, having peaked near $109,000 in January and pulled back as uncertainty around U.S. trade policy rattles risk assets broadly. A spot Bitcoin ETF approved by the SEC in January 2024 now holds approximately $50 billion in assets from institutional investors. BlackRock's iShares Bitcoin Trust is the fastest growing ETF in history by assets under management in its first year. MicroStrategy, now rebranded as Strategy, holds approximately 450,000 Bitcoin on its corporate balance sheet, purchased with proceeds from convertible bonds that the company issues specifically to buy more Bitcoin, a structure that the analyst Michael Green described in a January 2025 note as a leverage machine that creates buying pressure on Bitcoin while transferring risk to retail holders of the convertible bonds. Sound familiar? New paradigm. The current version is Bitcoin as a global reserve asset. The claim that nation-states and central banks will eventually hold Bitcoin the way they hold gold, and that a U.S. strategic Bitcoin reserve, which several senators proposed legislation for in 2024, would validate this permanently. The Senator Cynthia Lummis of Wyoming introduces the Bitcoin Act in July 2024, proposing that the United States purchase 1 million Bitcoin over 5 years. Bitcoin trades up 10% on the announcement. Easy money. US household debt is at $17.7 trillion as of the end of 2024, a record. Credit card delinquency rates are at the highest level since 2011, and yet crypto exchange app downloads have been climbing since October 2024. Trading apps with crypto integration report new account growth running at twice the 2021 rate. Social proof. A Bitcoin ETF is now available inside 401k plans at several major providers. Your financial advisor might recommend it. The asset class that in 2012 was associated with drug markets and dark web forums is now available inside your retirement account with the same interface as an S&P 500 index fund. Complexity. Can you explain how Strategy's convertible bond structure interacts with Bitcoin's price to create amplified volatility on the downside? If Bitcoin falls below a certain threshold, most of the retail investors buying Strategy stock cannot. Can you explain what a Bitcoin ETF actually holds, how it is custodied, what happens to your shares in a scenario where the custodian faces a legal action? Almost none of the retirement savers who now hold it through their 401k can either. Peak euphoria. In January 2025, Michael Saylor, the chief executive of Strategy, appears on CNBC and says that Bitcoin will reach $13 million per coin by 2045 and that any institution not holding it is making a career-ending mistake. The anchor nods. Nobody asks him to show his work. What is genuinely different this time? The Bitcoin ETF changes the institutional access question in a way that is real and structural. In 2017, an institution that wanted exposure to Bitcoin had to hold it directly or through an unregulated fund. The regulatory risk of that was a genuine constraint on institutional buying. The ETF removes that constraint. Institutional adoption is not a narrative in 2025 the way it was a narrative in 2021. It is actually happening, in measured form, through regulated instruments with proper custody. That is a different market structure than existed in any previous cycle. Whether it changes the outcome of the speculative cycle or simply gives the cycle a higher ceiling, and therefore, a longer fall, is a question that no one can answer honestly until after the fact. Watch for the Strategy debt structure. If Bitcoin's price falls below the threshold at which Strategy's convertible bonds can be refinanced, the company may be forced to sell Bitcoin to cover obligations, creating the kind of forced selling cascade that amplified every previous downturn. Watch for ETF redemption flows. When institutional investors reduce risk broadly, as they did in the first quarter of 2025, they sell liquid assets first. And Bitcoin ETFs are now liquid enough to be among the first things sold. Watch for the regulatory environment in non-US markets. If major economies tighten crypto regulations simultaneously, the global liquidity pool for Bitcoin shrinks faster than the US. Institutional adoption narrative can offset, not a prediction, a pattern. What you do with it is yours. The pattern is there. The question is whether you will recognize it in time. So why do we keep falling for this? Not specifically crypto, the pattern. Every generation, a new asset class appears at a moment of genuine institutional distrust or genuine technological change, and the asset's real novelty gets captured by a speculative structure that extracts money from late buyers and delivers it to early holders. It happened with canals, and then with railroads, and then with radio stocks, and then with internet stocks, and then with mortgage securities, and now with digital tokens. Each time, the underlying technology is real. Each time, the speculative structure built on top of it collapses and reforms with new vocabulary and new participants who have not read the previous chapter. The reason it keeps running is not that people are stupid. David, the San Francisco developer who turned 12,000 into 400,000 and watched most of it disappear, is not stupid. He made a rational decision given the information available to him in December 2017, and it was wrong. And it was wrong in a way that his intelligence could not have predicted, because the timing of speculative peaks is not a function of intelligence. It is a function of where you are in the crowd. The people who got in before you are waiting for you to arrive so they can sell. The people who will arrive after you will do so because you will be a data point in the social proof calculation they make about whether to enter. Everyone in the crowd is making a locally rational decision. The aggregate of those decisions is a market that transfers wealth from late buyers to early holders with a reliability that no individual participant can see from inside the position. Bitcoin may be digital gold. It may be a new monetary system that reduces reliance on governments that have historically abused monetary policy. Satoshi Nakamoto's 2008 paper may turn out to be as consequential as the invention of double-entry bookkeeping. All of those things can be true simultaneously, with the observation that the price of Bitcoin in any given week is set by speculation rather than utility, that the speculative cycles it has run through follow the same 7-step pattern as every bubble that preceded it, and that the person who buys at the peak of the next cycle will lose money regardless of what the technology eventually becomes. You cannot know in advance whether you are buying near the peak. Nobody can. What you can know is whether the social environment around you has the characteristics of a speculative peak, whether the people talking about the asset are talking about its price rather than its function, whether the entry points are being made easier and the warning voice is quieter, whether the financial instruments surrounding it are getting more complex in ways that obscure the underlying risk. Those are observable things. They do not require predicting the future. They require looking carefully at the present and comparing it honestly to what the past looked like at equivalent moments. That comparison is uncomfortable because it suggests that some of the people reading this right now are sitting inside a pattern they recognize from history and have already decided to stay in anyway. That is a choice. It may be a right choice. Early holders of Bitcoin who stayed through the 2018 crash and the 2022 crash are, as of 2025, sitting on extraordinary returns. The pattern produces winners. It produces them by also producing losers, and the losers are the people who arrive late in each cycle and exit early in the next decline because they cannot afford to hold through it. The winners are patient and often lucky about when they entered. The losers are neither. History will not tell you which one you are, but it will tell you what the room looks like right before the exit gets crowded. Pay attention to the room. Now I want to hear from you. Which moment in this story felt most familiar to something you have personally experienced or watched someone you know go through? And if you own Bitcoin or any cryptocurrency right now, what would actually change your mind about it? That second question is the harder one. Most people who hold it have a price at which they would sell and a set of conditions under which they would conclude the thesis is broken, and most of them have never written those conditions down. Drop that in the comments. If this changed how you read the next crypto news cycle, hit the like button and subscribe. Next time, we are going inside the moment when a small group of mathematicians convinced the entire financial industry to price risk using a formula that turned out to have a catastrophic flaw. A story about the gap between elegant models and ugly reality. History does not repeat, but it rhymes. And right now, it is rhyming loud. See you in the next one.